Hey traders, welcome to the Top Tier Outlook. Happy Sunday, everybody. Hope everyone's had a good weekend, or at least is winding down from a good one. We are getting a jump start on the week, and it will be an interesting week. We do have the FOMC meeting this Wednesday, and it doesn't necessarily mean that we're expecting any kind of change in rates. In fact, we are absolutely not expecting a rate change for June or for July. Neither one of them are really on the table when we take a look at the Fed Fund futures. And the goal of the Fed Fund futures is to allow speculators, traders like you and I, to basically make an educated guess and to place a trade based on what we think that the Federal Reserve is going to do. There is little to no expectation in July, and there's absolutely literally zero. I think it might be 1 or 2 or 3% expectation for anything to happen as far as a cut. So the cuts are getting moved out to a November, December, maybe September conversation. I think September is still a coin flip. Now, every jobs data that we get, every bit of inflation data that we get, and any messaging from the Federal Reserve can, of course, change what we're expecting in September. But this is where we continue. And, it's an easy thing to ask, and it's a good thing to ask at this point in the year. We're halfway through the year, which is, Rog, what if we don't get any rate cuts? And it's a good question to ask, but it also reminds us that we're not trading the rate cuts actually happening, right? We are, as traders, always trading expectation. So as long as there is some glimmer, some expectation of a rate cut this year, and there's actually two. One is definitely priced in, and there's possibly two. Very, very unlikely. I want to say it's less than 13%, might be closer to 11% expectation for three. So I'm going to take that off the table. So we're going to get 1 or 2 cuts this year. Whether we get them or not is not the point. Whether or not we expect them is how price action in indices, in currencies, and in treasuries is going to be. So we don't actually need the cuts to be able to continue to move higher. Now, of course, that then says that at some point, there might be that let down trade of, wait a minute, the Fed's not going to cut it all. And that is something that if we have to deal with that, we'll deal with that in 2025. But we still have to get through the second half of this year. We're going into the second half of the year in just a couple of weeks. And then we'll see going into 2025, maybe the rate cuts get moved out to 2025. And then the expectation starts all over again. And that's the way we have to remember that it's not reality, right? And I can't remember if it was in Charts and Coffee or maybe in Top Tier Outlook, that we remind ourselves that it's not perception and it's not perspective alone, right? It's when we're traders, we have to manage the perception versus our perspective, right? And as long as we can understand what the market perceives, and you might say, Rog, I got to go Google those two. Do it. I know I had to. I'm thinking, what's the difference between perception and perspective? Do it. And then if you want a little bit more of a deep dive, and this is absolutely applicable to trading, check out on YouTube, just Google perception versus perspective, and you'll probably see some shorts or even an interview with a guy named Andrew Bustamante. He's not a trader. He's actually an honest to goodness CIA spy. He's retired now, but he says that is a superpower. And I think absolutely he is correct. And he didn't know how correct he was because for traders, that's the world we live in. So check that out. But as long as traders are expecting it, we can continue to take advantage of what will be probably higher highs. Take a look at the NASDAQ as we start off our top tier outlook. And of course, if you have any questions, get them in sooner rather than later, and we'll be able to take a look at what's going on there. So take a look at the NASDAQ. You notice that the trend that we're getting in the second quarter, which we're still in the midst of course, end of June is the end of Q2, and I do not expect it to be a boring one. We could see a lot of rotation and a lot of repositioning because the expectation for cuts in Q1 was far higher and more than it is in Q2. But nonetheless, we'll worry about the end of the month at the end of the month. But you can see there's a little bit more volatility. There's a little bit deeper pullbacks, a little bit more lethargy in terms of being willing to punch up to higher highs. But yet, here we are. And as we like to say as traders, right? This isn't a Raghee saying, this is just common sense. All-time highs are never bearish, right? And so we'll continue to remind ourselves that there are certain stocks that are that are still quite strong, Nvidia, Apple, and it doesn't take many stocks to keep an index in an uptrend because the indices are made up of a very few number of stocks, usually less than 10, with the preponderance of weighting. It takes very few high-weighted stocks to keep an index going. So I'll give you just how high-weighted a world we live in. If you take a look at the S&P 500 stocks, the top 10 are nearly 20, I believe 20 or 22% of the entire index. That means the other 490 are battling it out. And as you go further and further down the list, away from, say, the top 15, you'll notice that most of the weighting is at 1% or less. So the only way those lower percentage weighted stocks in the S&P 500 can have any kind of meaningful impact on the index is when they have a large price move, like earnings or news or some sort of surprise. So that's where we sit. And so when we take a look at where we are, this is what we're looking at right now. And you might say, Rog, when are you ever bearish? I was bearish back in, some of you might remember if you've been with me for a bit, I was very bearish in Q3 and Q4 of 2018. I said, you know what? Federal Reserve is not messaging and not talking like they at Jerome Powell and company are going to pause the rate hikes, right? You can tell by their messaging they were still very hawkish, and yet the Fed fund futures were saying, Jerome, we expect to hold. And then in December of 2018, we did not get that messaging. We got a hike. And up until 2020 Q1, that was the swiftest sell-off we ever saw. And my logic is this. Is Jerome going to do that again? Is Jerome going to look at Fed fund futures and go, nah, I don't care what they think? No, because he went there once. He tested the waters out and it was disastrous. So the messaging is either going to change. What is the messaging? Every time Jerome speaks, every time we have a press conference like we will this Wednesday related to a meeting, and even some of the other members, we're going to have to listen closely to what they're saying, because if they want to prepare us for no cuts, Jerome is not going to do that again. I'm feeling pretty confident about it because he's been there, done that, and I don't believe he wants to go there again. So that's where we sit. All-time highs are never bearish. Now, not everything is punching up to an all-time high, which also takes us to the next level of understanding weighting. The three indices are weighted very differently, not only at the sector level, what sectors are most represented, heaviest weighted, but also at the stock level. So that the composition of the Dow is markedly different than the NASDAQ, and the S&P is a little like both of them. A lot of tech, but also financials and healthcare and energy. So ES ends up being this middle ground between NASDAQ on one side and Dow on the other, but they are made up very differently. And nowhere is that more obvious than just looking at the chart of the Dow. This is the year of the Dow thus far. And we can see here that it's not punching up to all-time highs, which then begs the question, what's going on with financials? What's going on with energy? What's going on with industrials and transports? And they don't look like what's happening with tech and what's happening with semiconductors, which are far more influential in the NAS and in the S&P. And that's why they're able to do what they're doing. So you're saying, Rog, wait a minute, we're hitting all-time highs because of two sectors? I'll go so far as to say we're basically hitting all-time highs based on maybe 4 to 6 stocks. And that's how much high concentration weighting affects these indices that we trade. Think of the indices as a bundle of stocks wrapped up with some leverage, and voila, you've got the futures contracts of the Dow, the NAS, and the S&P. So first question this morning comes from Sean, and we want to take a look at some metals. All right, let's do that. By the way, on the left side, you will see I've got the 5-minute chart of the Dow. It's a very, very early look at the Asian session, and you can see that it was weak going into Friday's close, and it's not hugely weak at the moment. In fact, we're up a little bit from Friday's close, but we'll see if we hold the range. And I would anticipate, if you're knowing that come Monday morning, 9:30, we have basically 2.5 sessions and we hear from Jerome Powell. I don't anticipate a lot of lower lows, although we could be heavy on some sessions, Monday or Tuesday, but I don't expect a lot of higher highs either. It would surprise me zero to see the indices remain mostly in the range between the daily price movement ranges before we hear from Jerome. But again, with a little bit more of a bullish leaning on the NASDAQ and the S&P. So with that being said, where does gold sit in that conversation. So gold is a metal that is, even though it's often called a flight to safety, it's not, nor has it really ever been that. What it is a play on real yields. So when the rate of inflation and the lower end of the yield curve, so think of the 1 to 3 year bond, when that chasm widens, gold will move. When that chasm narrows, gold will move. It's real yields or real interest rates. And if we're not expecting Jerome to cut, gold will move lower, bonds will move lower. And actually, some of the best gold trading we'll see is when gold and bonds are moving kind of similarly, right? So, am I bullish on gold? So, this is where I love my color coding. I'm not allowed to be right now, not on the daily time frame. That doesn't mean that we may not have a short-term swing on a 1 hour or even a day trade on gold, but I cannot buy on the daily time frame nor on the 1 hour red candles. So for now, I'm not super bearish. It's neutral, but it's neutral bearish. And I would prefer to be long gold if we're still marching towards rate cuts, which would be bullish to gold. Not because the cuts themselves are bullish, but because the environment that the cuts would happen within are a narrowing of the real yields. All right, so gold I'll have to put on the back burner for now. Now, GDX is an interesting alternative. I don't want to trade GDX unless I have a pretty good idea of what gold is going to do, because gold and gold miners, chicken or the egg, gold first, miners second. So both of these have to put on the back burner. Now, when we wander on over to silver, you can look at the SI futures or SLV ETF. When we wander over to silver, this might be a different narrative, but silver is a quirky metal. It's not as sensitive to real yield as gold, but it does have a sort of precious metal type movement to it. But it's not quite the manufacturing economic optimism of, say, strong copper. So it's a little bit like copper. It's a little bit like gold, right? It's not really its own thing. That's not the way I've found it to move for 30 plus years. However, I could be a buyer of silver. But remember, silver is seldom the captain of its own ship. So silver gets stuck between the push and pull of gold and copper, right? If gold and copper were to have a child, its name would be silver. So if gold is weak and copper is weak, I'm not going to be bullish in silver, right? And then that takes it to the next level, which is the XME. This is metals and mining. Now, GDX and XME spent a lot of Q1 and Q2 up until recently quite strong. That's not the case anymore. So when I dive into the top tier outlook, and those are either subscribers to that newsletter or members of the Sector Secrets Mastery, where you get that included with your mastery. And I hope some of you took advantage of the sale that we had at the Simpler Trading store, whether that be indicators or even mastery services, and took advantage of that 30% off. So when I put that newsletter out, you're going to see exactly where, when I put that chart of the ranking of the different sectors, you're going to see just how far those have really fallen from when they were really leading a lot of, or at least in the top 3, top 5 sectors for buying. The picture has changed. The picture has changed. And part of that's going to be just a little bit of the letdown that September really is a 50-50. It's a coin toss right now. It'll probably be clear at 2:30, 3 o'clock on Wednesday. But for right now, I have to leave these alone, and I'll see if there's some clarity after the FOMC meeting. And now you know why the FOMC meeting is so important, because of the way in which yields will affect what's happening, especially in gold. All right. So thank you for the question, Sean. All right. Next up is, when will they recover? So whether or not they do, I'm going to say they're more likely than not, but they're very much tethered, Sean, to the narrative around rates. So when I can only narrow it down to the possibility that we get clarity on Wednesday, late afternoon, probably the last hour before the bell rings on Wednesday. About that point in time, at 3 o'clock, Jerome should be done, or the bulk of whatever he's going to say should be said. And then we're going to go into the bond close at 3 p.m. Eastern. All right. And then we'll go into the close. And in that hour, we'll probably get a lot of clarity on that. Okay, so I would look for the window around FOMC meeting press conference, which the rate statement and the decision on rates, so a hold and then whatever the statement shifts are. And of course, those will be closely read. And then at 2:30 Eastern on Wednesday, we'll get the press conference. And that's the Q&A portion where Jerome can either clarify whatever was sort of, well, what does he mean by, what does the FOMC mean by this rate statement? What his press conference clarifies and then adds to whatever that statement had to say. All right. Next up is VST. And again, I'm not bearish gold, gang. I don't want to be in a short position. I just know that I would rather wait until after the FOMC. So VST is a mean reversion. Red candle means I really shouldn't buy it. However, in fairness, the entries for VST, and by the way, it's still valid. If you got in already somewhere between, I'd say 89 and 84, perfectly valid trade. And as long as it doesn't close below 84, piercing 84, not as big a deal, but as long as it doesn't close heavy, right, below 84, probably fine. The mean reversion triggered on the 4th and also the 6th, right? So that means if you had already gotten in, if I'm looking at my chart today, Friday's red candle prevents me from buying, because not only am I losing my mean reversion, it literally disappears by design to remind me that if those lines aren't there, I can't trade the mean reversion. But it did already trigger in the proper environment. So this would be a long position again in that zone. And if you got it, great. Whatever your stop is based on the validity of the trend, use that. I would tighten the stop up, however. Whatever your stop is when there's a trend, my typical adjustment, this is what we do in the Sector Secrets Mastery, my typical adjustment is if I get in during a trend and it wobbles, this isn't a downtrend, it's just a wobbling uptrend. It doesn't have quite the mojo that it had before. I'll just tighten the stop. I'll still give it some wiggle, just not as much as I would in the context of a trend. So Alex, that's what I would look at in VST. All right, Italo asks, what am I thinking about trading NVIDIA and SMH? So NVIDIA, the profit taking happened on the 6th. Friday was actually pretty strong, but it wasn't a huge bouncing day. It actually held its own pretty well on Friday. So we'll see what happens on Monday, but it's really not NVIDIA that I want a piece of, to be quite frank. It's really, I would rather take advantage of SMH. And the reason for that is there are a lot of other stocks in the semiconductor sector, SMH, that are in uptrends, including SMH itself. And this is where I differentiate between the boat, the individual stocks, and the type, the sector. If I have a number of the top 6, even the top 11 that are in uptrends, and I believe 6 of the top 11 are in uptrends in SMH, then I would rather trade SMH because, one, it's a very affordable way to take advantage of semiconductors. It's not a single stock narrative, right? But it has to absolutely respect that NVIDIA is 20+%. So if NVIDIA can pull back, which I would love, little profit taking maybe Monday or Tuesday, I'd like to buy SMH. Now, when that will happen, no clue, right? Here's the thing. We don't know when something's going to happen. Think of it this way. If you're a batter at the plate, the pitchers, how far away is the plate from the mound to the plate? I'm not sure. I used to remember these things. But all I know is that pitcher is going to throw something at me. The pitcher is the market. The pitcher is SMH. The pitcher is NVIDIA. I'm the batter. So what the pitcher is going to throw at me, when they're going to decide to let that ball go, I have no clue, right? But I know that I've got, 60, 70 feet. I've got to wait. I don't know. So I think the timing is up in the air. And remember, timing can be a little bit more specific to certain events that are on the calendar, different hot zones like that FOMC. But at the end of the day, here's what's great. I have price. So maybe it's a catalyst I didn't see coming. Maybe it's profit taking that suddenly hits on Monday or Tuesday. I don't know. It might even be at the end of the month. I don't know, but I can stay ready because I have my mean reversion already plotted on my screen and I have my daily price movement ranges waiting there. And by the way, if you're a subscriber to the daily price movement ranges and the hourly price movement ranges, we have a new stocks package that's going to go out, right, Bot? We have a new stocks package that's going to go out. That is going to include the adjustment to those price movement ranges for NVIDIA's split. Okay, so I'm going to tell you this. I don't know when it's going to happen, but I do know that if the trend is still up and I get my pullback to the daily price movement range, I know what I want to do, right? But just like waiting at the plate, my bat's going to be ready. I just don't know what's going to get thrown my way. So you gotta stay ready, not get ready, right? Just stay ready. And as long as there's a trend, that's a good reason to stay ready. All right, gang. So, by the way, look for those updates going out around lunchtime tomorrow for those of you that are subscribers. And thank you, as always, for being here for the Top Tier Outlook. My Sector Secrets Mastery folks, I will see you in the room tomorrow. We'll continue to look for opportunities, but know that between Monday and Wednesday, 2 p.m., we have a very short window before we get the FOMC, which could be a significant amount of volatility. And then the window for swings will reopen after that. So we have an interesting week that's sort of cut in half by that high impact event. And it is a high impact event, not because we're expecting any shifts in rates, but rather we're looking for confirmation that it's okay to continue to expect 1 or 2 rate cuts into the end of the year. All right, gang, as always, be good to each other. I'll see you tomorrow for Charts and Coffee.